The global cryptocurrency market is a multi-trillion-dollar structure, but the entire industry is built as a vertical stack. Every other project, exchange, and derivative sits on a single glowing bottom block, Bitcoin. Market crashes recently wiped out over $1 trillion in value across this ecosystem. These collapses exposed a level of fragility that the industry's growth had previously masked. MicroStrategy provides a specific look at this risk. By turning the company into a leveraged bet on Bitcoin, Michael Saylor saw his firm lose nearly $100 billion in market cap, with the stock price dropping more than 50%. Despite these losses, the community continues to rely on the claim first established in Satoshi Nakamoto's 2008 white paper that Bitcoin functions as a revolutionary peer-to-peer electronic cash system. The public narrative portrays Bitcoin as digital money, yet the actual data suggests a massive disconnect between the promise of electronic cash and how the asset is actually used. To test its utility, we have to use the 3 pillars of macroeconomics that define money. To qualify, an asset must be a medium of exchange, a store of value, and a unit of account. A failure to pass these basic economic tests suggests that Bitcoin's trillion-dollar valuation exists independently of any actual utility. The first test is the medium of exchange. This requires an asset to be an efficient, widely accepted payment for goods and services. This chart compares capacities. While Bitcoin handles 500,000 daily transactions, Visa processes 65,000 every second, clearing Bitcoin's daily volume in under 8 seconds. The energy cost is equally lopsided. One Bitcoin transaction consumes the electricity of an average American household over 43 days.
High costs and slow processing speeds mean that the Bitcoin network is technically incapable of supporting global commerce. The second requirement is a store of value, meaning the asset must preserve your purchasing power over time without erratic swings. Bitcoin's price history is defined by extreme volatility. 20% monthly swings make it a speculative investment, not a reliable store of wealth. It is also highly centralized. Just 2% of addresses control 95% of the total supply. This concentration allows a small group to move the market. The Jane Street lawsuit alleges exactly this, claiming the firm helped trigger the 2022 crypto winter and wiped out $40 billion in market value. Finally, it fails as a unit of account. Businesses that accept Bitcoin still price their products in dollars, only converting the price into Bitcoin at the exact second a customer pays. Having failed all 3 economic tests, proponents often argue that Bitcoin simply needs more time to be properly implemented. We have a real-world case study for that implementation. In 2021, El Salvador became the first nation to adopt Bitcoin as legal tender. The government launched the Chivo wallet and gave every citizen $30 in free Bitcoin to encourage people to use the system for daily expenses. Data from the National Bureau of Economic Research showed that 60% of users downloaded the app to cash out the $30 bribe and never used the wallet again. Even for cross-border remittances, a use case specifically highlighted by the government, Bitcoin accounted for less than 2% of the total market. Public sentiment followed the data. 66% of the population considers the National Bitcoin Project a failure, opposing any further public funding for it. When a nation attempted to force Bitcoin to function as money, the structural flaws identified in the macroeconomic tests became unavoidable real-world obstacles. If Bitcoin cannot function as money, produces no cash flow, and has no commodity utility, we have to look for what is actually driving its valuation. The answer lies in the greater fool theory. This theory suggests the price of an asset is justified as long as there is a buyer willing to pay even more for it later. In this model, value isn't derived from what the asset does, but from the belief someone else will purchase it at a higher price in the future. This creates a cycle. Demand drives the price higher, attracting more buyers through hype. The cycle repeats until the pool of new buyers is exhausted, making the market dependent on a continuous influx of new participants just to survive. The shifting stories, from digital cash to digital gold to an inflation hedge, function as marketing campaigns designed to pivot whenever the previous promise fails to deliver. These narratives exist to solve the greater fool theory's core problem, the constant need for new buyers to prevent the price from collapsing. Stripped of its stories, the asset is a massive experiment in the greater fool theory.
The price remains up only as long as new buyers enter the market, and eventually the supply of greater fools will run out.